The Russell 2000 went absolutely crazy today, up about 2%. At the same time, the Nasdaq and the S&P underperformed, and the Dow outperformed the S&P and the Nasdaq. This is a trend that I think will continue, something we have talked about since election day first and foremost. This outperformance, this broadening out of the markets is going to occur rather than big tech holding the market leadership. Now, there is some news to explain this. You also have a massive bid in treasury markets today, which is bringing down 10-year treasury yields about 13 basis points, which is the equivalent of half of a rate cut. That's a big deal. Tom Lee on CNBC says Trump's cabinet picks suggest lower policy risk for the markets. So let's take a listen. Then after we hear from Tom Lee, we'll obviously go over all of the nitty-gritty of what you need to know and what could be coming next for markets.
Tom Lee joins us this morning, fundstrat Global Advisors, Head of Research and a CNBC contributor. Tom, great to have you.
Good morning.
Happy Thanksgiving in advance. You do write about some clearing events that we've gotten through, right?
Yes.
One is clearly best into Treasury, and then Nvidia's earnings too kind of remove some uncertainty?
Yes, and we could tell the market was sort of holding their breath on both, because once Nvidia reported, the markets began to levitate. And of course, we're seeing the market reaction today to Treasury Secretary. These are all both good events, but also showing you there's been a lot of cash on the sidelines. Which is why we're rallying.
Right.
Yeah.
Although making a pretty good yield, I imagine. What's the impetus to leave those sidelines if rates can hold these levels overall?
Well, I think one thing we have to keep in mind is there's $7 trillion of cash on the sidelines, which I think in general portfolios are overweighted and risk-free. And I don't know if it's going to be 5% 2 years from now. So I think investors, as they're planning ahead and they're seeing an economy that's resilient, I think the case for equities is still very strong right now.
Have you done any work on earnings for next year or the year after?
We're actually working on it now. Our outlook comes out December 12th.
All right. So we'll check back with you then.
Yeah.
Meanwhile, what sectors do you favor at this point?
Well, I think the template that we think makes sense is buy things that either benefit from a dovish Fed or a Trump White House, which is small caps, cyclicals like the financials, the regional banks and industrials, and of course crypto, especially Bitcoin and some of the proxies like MicroStrategy and Semler Scientific.
But did you hear what we were just talking about? Can the Trump administration get away with the pro-growth policies and a dovish Fed at the same time? Because some of them work against the Fed being able to cut rates.
Yeah. I mean, I'd say the market is very skeptical at the moment. That's what we're hearing from our clients. But that also means that's room for positive surprise. And I think one thing to be mindful of is the Fed can be dovish even if there's resilient growth, as long as inflationary pressures and expectations remain intact. And so far, that's been the case.
Has it, though? We're seeing a little bit firmer core readings on inflation, and I guess it depends on what he does with tariffs.
Yeah, but if you look at survey expectations, whether the Federal Reserve Survey or UMich, we're seeing 5, even 6-year lows on inflation expectations. So we're back to pre-pandemic levels from what consumers see. And then if oil falls, as you know, that sort of pushes down the inflation forward curve.
On the 1-year expectations, right?
Yeah.
Fives have not been as well behaved.
That's right. And, those surveys are notoriously a little funky, because if you look at the range of answers and the actual data, some people put 1,000% as the survey answer. So they can tend to skew the actual medians.
Right. Meantime, there is this school of thought that commodities are not suggesting rampant inflation or a return to a double-top CPI. You got Europe increasingly exporting disinflationary narratives, certainly China.
Yes,
right?
That's right. And I think there are many people who thought inflation would pick up because of tariffs. But as you know, it's not clear really what ends up being implemented. And if we get milder tariffs, that's actually less inflationary pressures.
Page 1 of the Times over the weekend was about companies elbowing each other to get in front of the president-elect to make their case to be carved out of tariffs.
Yes.
And then this morning, Reuters has a piece on the farm industry, again, looking to be exempted from deportationary efforts. How much policy risk do you think is going to be embedded in the next year at least?
Well, I think this is what investors are concerned about, because we know that there was a campaign that was run on tariffs and deportations, but as you know, those can be very harmful to the economy. So I think that having the right cabinet picks can actually get us into sort of the right blend of sort of outcomes. And I think that's what the market's starting to price in.
Meaning you've been impressed with the picks so far?
Yes, I think not only have I been impressed, but we can tell from our client feedback that the market's really like this.
Which I have to say, I agree with pretty much everything that Tom Lee said there, especially where he says that there's still people that are skeptical. And it feels like there's more skeptics today than there was just, a couple of weeks or a couple of months ago when things looked a little bit more dicey, like we could have a pre-election correction. Nobody seemed to be as, bearish then as they are now. And a lot of the argument comes down to valuations. But if inflation starts to surprise to the downside, if the tariffs are not as bad as some people fear, then that could be a reason for markets to move higher. And when people are skeptics, that creates room for upside surprises. If everyone's bearish, then, obviously there's room for upside surprises. If everyone's bullish, there's probably not as much room for upside, surprises. So I think there is still room for some areas to do well. As I've explained here on this channel many times now, I think it's really going to be small caps, values, some of your, healthcare names that really just have not participated in the markets the last couple of years that see the outperformance. Because one, those are the areas where expectations are low and you can probably exceed expectations. If we do have lower than expected inflation, those are the areas that will benefit from that. Also, on a move like today where treasury yields come down, cyclicals and small caps, those are the areas that benefit from that. I think you're seeing the drag on big tech today because they're no longer the only party in town. They're no longer the only stocks that can work in this market. Now, one of the biggest drags on the overall markets today is Nvidia. Nvidia is down almost 4%. Netflix is also down about 3% today. These two companies alone are dragging down the S&P more than you otherwise would have seen. And Nvidia's move lower is really just a continuation of earnings that again shows that you don't have to be an Nvidia to outperform the markets anymore. It says here, Nvidia stock falls. Why shares are still down after earnings. And it has to do with Nvidia executives that have met with Chinese officials in recent days. Presumably, if Nvidia's talking with Chinese government officials, then that could make Nvidia maybe a little bit more of a target in a new Trump administration. That, I think, is problematic. But you also have here that billionaire Ray Dalio sold Nvidia stock in the latest quarter. And that's not great. They reduced their position sizing by about a quarter, selling 1.8 million shares worth around 212 million. That's not a great sign of confidence for a stock that has seen so much positive news and positive attention in recent quarters. Now let's face the facts. I think all of your big tech stocks are going to be hit with this at some point over the next year, where you start to see some depositioning from some of your more legendary investors, billionaires, if you will, that try to reposition into other areas that could do better under a Trump presidency. And Nvidia is just the first one that it's taking that hit today, really because they just had earnings and things are slowing down overall at Nvidia. As I said at the beginning of this video, Donald Trump chose a hedge fund executive, Scott Bessent, for Treasury Secretary. Now, Trump said in a statement, which called the prospective nominee, quote, one of the world's foremost international investors and geopolitical and economic strategist. Okay, Wall Street loves when Wall Street is in government, for obvious reasons. He's less likely to put forth policies that are going to be bad for the markets, right? Bad for his buddies and bad for his friends. That's first and foremost why this is good news for the markets. But his actual plan calls for a 3-3-3 kind of rule. To drill 3 million more barrels of oil, to have the deficit at 3% by 2028, and to have 3% GDP. So this basically means, long story short, less government spending, less inflation. Now, why this is, again, really good news on the inflation front is because today we're running about 7% deficits, okay? So that is like the equivalent of recessionary times, like World War II times, right? Where the government's just spending a lot more than they're bringing in. Now, minus supply shocks, okay? Government spending is the sole reason for inflation, and I will explain this how Milton Friedman once did. Corporations have always been greedy. They've always tried to have the highest margins. Consumers in recent decades have always spent all of their money. Hence, 60% of Americans are not prepared for a $400 emergency expense. The only thing that changes is government spending, okay? Minus supply shocks. So COVID, it was two parts. It was one part supply shock. It was one part overspending from the government. So it was not just the government during that time. It was obviously supply shocks, okay? But here's the difference. In a normal, crazy world where there's no supply shocks, it is only government spending that causes inflation. Because what happens normally during supply shocks? Whether it's good or bad, whether demand picks up for, semiconductors. Let's use that example because that's kind of what we're seeing right now, right? Everyone wants to get semiconductors. What's happening? More competition comes online. More options come online. Vice versa. If demand falls for something, there's less supply, okay? So in a capitalistic world, Wall Street just makes up the difference for the imbalance of supply and demand on either side of the equation. Bottom line this, you have more oil supply, aka less energy inflation, you have less government spending, which equals less inflation, and you have 3%, projected GDP from the Treasury Secretary. Stronger growth with less inflation tends to be positive for small cap companies. Now, this is causing a large bid today in the bond market. You can see this in TLT. TLT is up 2.56% today. That means investors are going out and they're buying bonds. That is driving down yields. Yields are down today. Now, 14.5 basis points on the day today. No shocker why small caps are massively outperforming. And really, with that backdrop, why would you own Nvidia? Why would you own any big tech stocks? It makes no sense. They've been the defense trade. They've been the trade you would want to own if there's more inflation, if the Fed needs to raise rates, or if there's some kind of recession. Besides that, big tech is way over expensive. I mean, big tech's really skewing the index to look more expensive than it actually is. The average stock or the median stock in the S&P is trading at about 18.5 times earnings. Big tech's trading at over 28.5 times earnings with lower growth than what you can expect to see at small cap names or mid cap names. That's not a great setup for big tech, and that's purely why I'm just not that optimistic about the headline S&P. Now, we did have some bad news today. Liz Ann Saunders on X says Chicago Fed National Activity Index for October came in at negative 0.4 versus negative 0.2% as was the estimate, and negative 0.27% in the prior month. The worst reads since this past January, with breadth that was quite weak. 55 out of 85 individual indicators made negative contributions. If you take a look at now the last 5 months in a row, you have been negative. It looks like April was the only month that has been positive since February. So that's not good. This is likely having some kind of positive effect, though, pushing more demand into long duration treasury bonds, and should, over the coming days, as long as the data coming out Wednesday is not super strong, raise the odds of a Fed rate cut December 18th. current probabilities are about 50-50. It's a coin toss, exactly. 50.0% chance of a rate cut and 50.0% chance of a pause. So there's really not a lot of certainty on what the Fed's going to be doing next. On Friday, the markets were skewed towards the Fed cutting rates. 54.4% was the probability for a December 18th cut, and a 45.6% chance of a pause. Again, now it's 50-50. I think with the data today, it should be a little bit more skewed towards a cut. And I think the Fed does still want to cut in December, right? And then 2025 looks more like a toss-up at this point. We're expecting 3 cuts in 2025, but you know, we may get more than that if inflation comes in on the low side. We might get less than that if inflation goes higher. And what's actually quite contrary to what some people are starting to expect on Wall Street, Ryan Dietrich says here, no month is more likely to be higher than December in an election year. 83.3% of the time, December is a good month with what looks like an average return of over 1.3%. This is why markets are moving higher, at least internally, especially if you look at the RSP, the equal weight S&P is up almost 1% today. I do expect this is probably going to continue. I think there's a stronger case to be had of a broader market rally into year end. Then we need to sell the inauguration. Now, I think eventually we will sell the inauguration. I think we could actually sell the start of 2025. But from now into 2025, into the start of next year, I just don't see a strong bear case at this point, besides people trying to front run the selling, which that kind of reminds me of the election. Okay, everyone was kind of bearish heading into October because markets normally sell off before the election. That did not happen right up until the election. The first, the 3 days before the election, the market sold off, but everyone was kind of wrong forecasting that, early to mid-October sell-off. It was like late October. And it just happened right before the event itself. So I don't think trying to sell December in anticipation of the inauguration makes a lot of sense given what we just experienced with the election. Now, CNN's Fear and Greed Index sits at 61. Market momentum, extreme greed. Stock price strength, fear. Stock price breadth, fear. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is greed. And junk bond demand in extreme greed. Now, the percent of stocks currently trading above their 50-day moving average having another really strong day today. 66.5% of stocks trading above that 50-day moving average, up 4.3% today. 3 days now in a row, markets have continued to broaden out, and I think this is part of a larger trend. At some point, the broadening out will slow down and markets overall will slow down. You will consolidate some of the recent gains that we have seen, but I think there's room for markets to move higher still into year end. If you are nervous right now, if you are getting bearish, then I think it's time to probably take some profits on positions and to build up some cash, because the worst thing that can happen is a correction or crash and you don't have capital to buy that, because I think there will be a correction in the start of 2025 in Q1, possibly Q2, revolving around a growth scare and Trump tariff scares. Okay, we've seen that before in 2018. It's going to happen. Okay, and you want to be prepared to buy on that. If you have positions you're not exactly in love with that you have big profits on, this is your time. If you're bearish in the comment section of this video, you better be selling some positions. You better be raising some capital, or don't spread the bearish narrative. It does nobody any good if you're not even going to follow through with your own thesis. And eventually I will be selling some calls, right? Maybe selling some puts, maybe selling some positions. Right now I'm not doing that though, because I'm heavily weighted towards the single stock areas that have been doing well. And I think you're more than likely going to have a Santa Claus rally. And that's my opinion. And that's how I'm positioning my portfolio. But I most certainly will be heading into 2025 with some hedges on the portfolio. Maybe quite a few hedges on the portfolio. It might be a decently large hedge trade if I don't decide to sell or take profits in other areas. That's to be determined. But again, we will have a correction at some point in the not so distant future, but I just don't think it's right now. So if you're, buying hedges right now, you know, I think you want to be careful because these things usually take more time than people expect. So let me know what you think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.